Have you ever wondered where money really comes from? Not the cash in your wallet, but the money banks create every single day.
Most people think banks only lend the money that savers deposit. Sounds logical, but that's not how modern banking actually works.
When a bank approves a loan, it doesn't take money from someone else. It creates brand new money, digitally, on the spot.
That loan becomes a deposit in your account. No printing press, no vault cash, just numbers added to a screen. This is why credit drives the economy. Every new loan expands the money supply, out of thin air. Banks don't need the full loan amount in reserves. They only need a small fraction to meet regulatory requirements. This system is called fractional reserve banking. It allows banks to multiply money throughout the economy. Every loan earns interest. Since the money was created digitally, that interest becomes pure profit for the bank. When banks stop lending, money stops expanding. That's when recessions and financial crises begin.
Central banks don't create most money directly. They control how much banks can lend by setting rates and rules. When loans are repaid, that money doesn't circulate anymore. It actually disappears from the system. Because interest isn't created with the loan, someone must always borrow more to keep the system running.
Those closest to money creation, banks and large institutions, benefit first and benefit most.
The hidden cost is inflation. As more money enter the system, your purchasing power slowly declines.
Our entire money system is debt-based. Nearly every dollar exists because someone owes it back. This system affects everyday life, from grocery prices to rent, mortgages, and the cost of basic living.
As banks create more mortgage loans, home prices rise, pushing ownership further out of reach. Easy credit fuels economic booms. But when lending gets excessive, financial bubbles are formed.
When those bubbles burst, debt remains, but the money and wealth vanish. Workers and small businesses pay the highest price, while major banks often get rescued. When the system breaks, governments step in. Trillions are created to rescue banks deemed too big to fail.
That rescue money isn't taken from savings. It's newly created, just like bank loans. When losses are covered by bailouts, banks take bigger risks, knowing they won't fully pay the price. This creates a cycle of lending, crashes, and rescues, repeating again and again.
The system survives because it's complex. Most people never see how money is actually created.
Today, most money exists digitally. Cash is just a small fraction of the total money supply. Seeing money in your account feels real, but it's mostly numbers created by banks out of thin air.
Debt isn't just a burden, it all fuels growth. Loans allow businesses and consumers to spend and expand.
The first step to financial awareness is understanding how money is really created and who controls it.
But unchecked debt can spiral out of control, risking the stability of the entire financial system.
Banks can create money at will, while individuals must earn it the hard way. That's the fundamental imbalance.
Central banks influence lending by setting interest rates, indirectly controlling how much money enters the system. More money in circulation can lead to inflation, where prices rise and your dollar buys less. Every credit card swipe or personal loan adds new digital money into the economy instantly. Banks operate with leverage, creating 10 times more money than they actually hold in reserves. Banks create money out of thin air. The system is fragile. Small shocks can cascade into big crises.
Banks are interconnected. Trouble in one can quickly spread, affecting the entire economy.
For most people, understanding bank money creation seems complicated, but it affects everyone's life daily.
Some turn to alternative money systems, like cryptocurrencies, to bypass traditional banking limitations.
Understanding how banks create money is the first step toward taking control of your financial future.
Every loan a bank makes instantly creates money that fueled businesses, purchases, and investments.
Most of this money isn't seen physically. It's created invisibly, in the form of digital deposits.
As banks inject more money into the system, inflation can rise, reducing the value of your savings. The key takeaway: banks don't just store money, they create it, shaping the economy every day. When banks lend excessively, they risk defaults that can trigger financial crises.
When you break it down, the system is simple. Banks issue loans, create deposits, and expand the money supply.
Central banks influence the flow by adjusting rules and interest rates, indirectly controlling how much money exists.
Banks creating money out of thin air drives growth, inflation, and sometimes financial crises. It's all connected.
The more you understand how money is created, the better you can navigate, protect, and grow your own wealth. Every paycheck, loan, or credit card payment you make is part of this larger system of money creation.
If you want more videos breaking down money, banking, and finance, hit that subscribe button and tap the bell to stay notified.